A very good morning, students. Our session of Financial Management 1. Now, as far as our previous session was concerned, in the last session, we have discussed about the capital structure, and in that we have seen about the concept, the meaning, and the factors of an appropriate capital structure. I think it is clear to each and everyone. So now today we will discuss about the new point, that is determinants or affecting factors of capital structure. Here we are going to discuss that points that directly or indirectly affect the composition of capital structure of any business entity. So there are total 12 determinants which we will discuss one by one. The first one is nature of business. As we all know that the capital requirement and the capital composition is directly related with the nature of the business in which the organization is. So, if the organization has a fixed and regular income, then they can directly raise their external capital through debentures and preference shares. If the income is not fixed and if it is not regular, but the financial position of that particular entity is very strong, then the organization can issue equity so that the payment of interest or the payment of dividend will not be there. So, the composition of capital structure is totally depends upon the nature of business in which the entity is. If they have the regular income, then they directly issue debentures or preference shares. And if the regular income is not then the organization can issue equities. So for these reason only, the capital structure of the business is differ from individual to individual or organization to organization, because each and every business or each and every organization does not share the same financial position or the same mode of their income. So that is the first point. Second one, that is money market conditions. Here we are going to focus on the money market condition, that how the flow of money is there in economy. What is the total supply of money in the economy and how the money cycle is going to work. So, if the money is freely available in the market, if each and every individual, each and every person has total amount of money, then directly we are able to raise our capital through equity, because it is totally risky capital and the individual have a greater purchasing power with them. So we can easily opt for equity shares. If the money market condition is not good in our economy, if there is no regular income of our investors, and at that point of time, if the organization is going to issue debentures and preference share, then directly investor will opt for that option, because in this recession period, in this time, they prefer the fixed and regular income from the organization. So definitely the composition of capital structure is directly depends upon the money market condition of our economy in which we are serving. Third one, that is stability of earning. If the organization is earning very high but there is no stability at all, so at this or in this situation it is really very difficult for the organization, that is to offer debentures or preference share in a capital market, because here organization themselves are not sure about their earning. Then in that situation, how they are going to offer a regular or fixed income to their investors? If the earning is stable, then they directly issue preference and debentures to their investors. But if the earning is not stable, if the earning goes up and down on a regular basis, then it is very difficult to issue preference and debentures. So that is the third point. Then after fourth one, that is capital requirement. Yes, here we are going to judge the capital requirement of our business unit. If the requirement is for the longest period of time, then it is advisable for the organization to issue equity shares only, because in equity the organization is not going to repay the principal amount to their shareholders. So it is very convenient to the organization to issue equity share capital if the capital requirement is for the long period of time. And if the capital requirement is not for the long period of time, and the capital is required only to manage their working capital, then it is advisable to issue preference and debenture to raise their capital. So it is totally based upon the requirement of capital in the business unit. Then after retained control. Yes, it is really very interesting point. When the management does not want to lose their managerial control, and when the management want to control the whole business by themselves only, so at that point of time they are not going to issue equity shares, whatever the capital requirement of the business unit. Because if the organization issues equity shares, then the equity shareholders have a power to make the decision in the managerial aspect of our business concern. So they have the voting rights. They have a right to choose our auditor. They have a right to choose the removal of or the remuneration of our auditor. So when there is an active participation of equity shareholders in our managerial decision, then definitely organization lose their control. So if organization does not want to lose their control, or they have to had a retained control in 100%, so at that time they are not going to prefer equities to raise their capital. The next point is long term interest of the company. Here we are going to see from the point of view of the organization. If the organization want to build a strong position in their market, whatever the economic condition of the business is there, but if they want to sustain in the market, so they are going to have the capital structure on that basis. If during the depression, suppose when the depression is there and when the organization again they are not able to work in a proper manner, and if the organization take the risk for the issue of debenture and they issue the debenture, they pay interest to their debenture holders timely and regularly, then definitely the company will survive in a long period of time. If there is a boom in the market and in this point of time, if there is a no long term requirement of capital, but still company issues equities in the market, so at that point of time they offer a risky capital in the market, so ultimately company will sustain in a long period of time. So it is totally based upon the psychological concept of the organization. Means they are only for the profit making or they want to run their business in a long period of time. Whatever objectives, whatever goals of the organization, on the basis of that objective, the company will select the capital composition for the particular period of time. The next one is nature of assets of the company. Yes, definitely it affects our composition of capital structure, that is nature of assets. If the company does not have any fixed assets with the higher value, then they are not able to issue debentures, because debenture is our borrowed capital, and for borrowed capital, one means organization need to put some securities to raise their borrowed capital. So if the security is not there, if the security of higher value is not there, then the company is not able to raise their capital through debenture. So if the nature of asset with the organization is not fixed and it is not of the higher value, then definitely the company will not raise debentures or bonds in their debt market. Then after, the next one is level of interest rate. Here we are going to see that the interest rate which is offered in the debt market to our organization. If a company want to raise the capital but the interest rate is really very high, then company will go for equities. And if the rate of interest is low, so at that point of time the company will raise their capital through debentures or bonds. So it is totally depends upon the interest rate which is offered by the market for the debt securities. The next one is Attitudes of investors. Definitely, whatever the economic condition, whatever the financial condition of country, of the company, or of any individual, if the attitude of investor is very risky, then definitely they will prefer equities in any condition or any financial position of them. If the nature of investor is risky, then they will prefer equities at any point of time. But if the market is booming, if the market is prosperous, but the nature of investor is risk perception, means they are the risk seeker, then they will prefer debentures or preference in any condition. If the tax rate of the government is really very high, so in this particular situation, the company will prefer to raise their capital through debenture only, because as we all know that the debenture interest is totally tax free. So if the company wants to raise their capital for the long period of time, but the tax policy of the government is really very strict and the rate of tax is really very high, so in that condition the organization is going to raise their capital through debenture only. They wishes to raise equities, but as per the government policy they are not going to raise their capital through equity. So it is totally based upon the taxation policy that the government is going to offer in our country. Then after, the next point is cost of financing. Here we are going to focus on cost of each and every source through which a company is going to raise their capital. If the cost of equity is very high, then company will prefer to raise their capital through preference or debenture. If the cost of capital of preference and debenture is high, so at that point of time they are going to raise their capital through equity. So it is totally based upon the cost of capital through which the company is going to raise their capital. And the last one, that is legal restriction. If by law, by judicial decision, if the company is not going to raise their capital worth some initial amount, so at that point of time the company is not going to raise their capital. If in the initial period company is not allowed to raise their capital through debenture, through bonds or through preference, so at that point of time they compulsory raise their capital through equity only. So if there are the legal restrictions, then the organization, the companies have to follow on a proper manner whatever the financial requirement of the company is. So it's about the determinants or the factors that are directly affects the capital structure, the composition of the capital structure.